Hey everyone, in this video we're going to be talking about key earnings reports from the last week in the market, looking at how they did, who performed well, who's giving good outlooks, who didn't perform well, what it meant for their stock price, and getting into it a bit deeper in some of their reports. Now if you like this content, please consider liking that video, subscribing to the channel. We do more content like this, but also go over stock analysis, portfolio overviews, so would really appreciate it if you guys stick around on the channel, check out some more of the videos that we have here. But getting into this week, it really started on Tuesday because Monday was kind of a holiday, no meaningful earnings at least that I was interested in. And on Tuesday, it kicked off with a bang with some huge retail earnings reports with Walmart and Home Depot. If we go into those stocks a bit more, Walmart was priced very expensive going to this report, so I'm not surprised to see that they had a bit of a dip. Honestly, I was expecting even more of a dip in their stock price, currently trading at about $142. If we take a look at their report, I'm pretty sure their Q4 is supposed to be their best quarter of the year because it's holiday, lots of store traffic, lots of events with big groups, lots of gift giving, and their EPS was about $2.30 a share, which is about half their EPS that they did on the whole year. What's a bit concerning is we see their margin trend down, operating income trend down. So those are some things definitely to keep an eye on. If we just look at the overall year and the value of the company from an PE perspective, they did $4 to $5 of EPS, but they're trading at $140. So even if we give them the benefit of the doubt to $5 because they have a higher adjusted number there after they take whatever they want out of it, but that's still, a 28 times forward or trailing multiple, which in this environment, I think Walmart still probably has some risk, particularly on their consumer discretionary categories as like the consumer weakens. So paying 28 times trailing, I think there's probably better value in the market. Walmart's obviously a great overall business. I just think it's probably getting the price premium that it deserves, if not more. So that's my thoughts on Walmart, and their earnings bring their stock down, albeit pretty slightly. Going over into the Home Depot, we saw a very similar trend on consumer spending impacting the results as well as the outlook. But since they're a bit less hedged with consumer staple categories, we see the volatility in the consumer hit a retailer like Home Depot more. So down 7% on the week, but from a price to earnings ratio, you can kind of see you're getting a much better value, about 18 times instead of 28 times. So you're paying that discount because you're getting the lower quality of earnings since they don't have as many or as much of their revenue tied up in consumer staples. So this is one I'm more interested in than Walmart, but honestly still not overly attractive, still a high teens multiple for a business that can see some weakness and is pretty reliant on the consumer, housing builds, people renovating their home, which are high cost projects. Going into Wednesday, so there were a lot of stocks here on Wednesday. The one that I was interested in is TJX. Going and looking at TJX's business here, very similar trend as the other retailers. You can kind of see them trading at about a 26 times. So a bit cheaper value than Walmart, and they really do cater to consumers that are looking for discounts. So some people may be trading down into TJX for clothing and stuff like that, but they don't sell grocery. They don't play in lots of those lower margin categories that are more of a staple. So I think that's why they're getting a bit lower of a multiple than Walmart. Walmart's also just been doing it for so long that they've kind of earned the reputation of being able to deliver long-term value to shareholders. TJX has done phenomenal if you look past 5 years and stuff like that. But I think just relative to Walmart as a brand and a business in US retail, they tend to get the benefit of the doubt on valuation. So this is one that, similar to the trends we saw in Walmart and Home Depot, we see their stock trend down a bit. Their valuation in between Home Depot and Walmart. But once again, not an area of retail that I'm really interested in being in, especially at these earnings multiples that they're trading at. on Thursday, we get into a lot of interesting names. One of the biggest um, swings in the market this week was Domino's Pizza. So on Domino's, this has been a stock that has performed extremely well over the last 10, 15 years, even going from 2015. So last 8 years is up even after the dip about 200%. And if we go back to 2010, you can kind of just see crazy returns there, 2100%. So long-term investors really love their business model. They buy back tons of shares. They're a franchise model that's scaling globally with very low capex spend, and they attract a lot of different types of consumers. They really double down on delivery, and we're seeing some of those trends kind of catch up to them a bit. As we look at their 5-day window here, down 16% this week behind earnings, and their price to earnings ratio is now down to 24, whereas this stock has kind of traded closer to 30 for a while because of their growth trajectory and how much value they've been able to create in driving same-store sales growth as well as international expansion. So looking a bit at their numbers here, you can kind of see they were a bit weak on earning or revenue rather, missed by about $40 million, but I don't think that was the big picture. EPS, take with a grain of salt. I think they gained 46 cents a share from selling some corporate stores. So they really came, call it, in line with expectations. But what really fueled the sell-off was same-store sales growth going from the expectation of almost 4% to under 1%. And then franchise-owned sales growth even lower than the 0.9%. Just misses across the board on same-store sales growth. They also brought down their guidance on medium-term store openings and same-store sales growth from kind of high single digits to mid-single digits. So as investors and analysts updated their models, that had a really big impact on their current day valuation. As we look at their overall performance here, in terms of numbers, one thing I like to see is they continue to buy back shares. That's been a really big part of their share price accretiveness over the last decade. But you can see even in this time that they're not doing phenomenally from a growth standpoint. They had 37.7 million shares at the end of 21, and at the end of the fourth quarter, or weighted in the fourth quarter, was 35.7 million. So they bought back like 4% of the company over the last year and a bit. And you can kind of see the weighted average in 2022 was 36. The weighted average in Q4 was 35.7, which tells me they continue to buy back shares month over month, probably week over week, up until the end of 2022. And they're probably continuing in 2023 as well. Bit of a watch out here as like inflation and other costs have caught up with them a bit. You can kind of see their EPS, adjusted EPS, at $12.50, which is actually down from $13.60. So $12.50, if you slap a 20 price to earnings multiple, that's $250 a share, and they're at about 300, I believe. So yeah, the 24 PE checks out as in terms of the price you're paying here. But this is a stock that's done a really good job of long-term growing earnings per share. So if you think they're going to get back on that trend, this would be a good time to get into the stock. They also increased their dividend over time, even though it's a weak starting yield, or small starting yield. So this is more my kind of business, my kind of company that I like investing in. Capital light, takes lots of their capital and returns it to shareholders in buybacks and dividend growth as they expand globally by franchising and just taking a royalty off the top. So this is one that I'm actually looking at putting on my watch list. I still think, while it's probably a fair value given the company's history, I want to buy it if I'm going to buy it at a lower valuation. So I'll look to see if I can get this stock closer to 20 or something like that, and then I'll consider adding it to my portfolio. I'll weigh it against some of my current restaurant stocks I own and see if I'd rather allocate some capital here instead of there. So this was probably the most interesting report that I saw in the market. One of the other ones from Thursday was Intuit. And finally, we have a company that beat expectations this week. So Intuit, if we look at their stock, was up 5% on the week, mostly driven by the earnings. you can kind of see their numbers here. Really strong revenue growth, 14%. They have huge swings between their GAAP and non-GAAP operating income and EPS, which is like very hard to back out. So I'm not going to comment too much. All I'll say is even if I give them the benefit of the doubt on the non-GAAP numbers, this is still a company that's super expensive, trading, like 50 times earnings, it looks like, if I just give them a recurring EPS base over their stock price of over $400. So this company, for those of you who don't know, own like QuickBooks, TurboTax, those types of businesses. So software business, providing great services. I think they own MailChimp as well. Oh, up here. Credit Karma, TurboTax, MailChimp, QuickBooks, Mint. So great business, but in this environment, I'm not paying 50 times earnings for a company like this. So happy for them for beating their results. Glad to see someone beat this week. But at $120 billion market cap for what this business is and the cash they spin off, not overly interested. And then another company that reported on Thursday was Square or Block, whatever you want to call it. And they had a bit of a mixed report. If I look at their earnings here, they actually had pretty good gross profit numbers, accelerating sequentially and year over year. Both their Square business and their Cash App business delivered growth, which is what I was looking to see. But where they missed my expectations and just Wall Street's expectations was on overall profitability. So the logic would be on a business like this, as they scale, they're getting more and more profit accretive. But as they're making more money here, we are actually seeing a larger loss than we saw a year ago, last quarter, on both the quarter, but then also on the year. Look, this is the biggest loss on net income they've had in 5 years, even though it's by far the most revenue that and gross profit that they've generated. So I'm not in the weeds enough to understand the investments they may be making that are driving this net loss. But I'm just not interested in adding a company that hasn't been sustainably profitable. And not only that, but one that has had 1, 2, 3 straight fiscal years holistically that they've been decelerating net income, even as they have been accelerating their profit and their revenues. So I'm sure there's stuff going on here. Not interested enough to look into it. I think I also mentioned on a prior video, I also hate the buy now, pay later space. And this company acquired Afterpay, which is about a quarter or a third of their value is in that company. And I'm just not a big fan of that. Honestly, that may be part of the unprofitable driver that's driving their net margin declines over the last few years, since I don't know how that's going to become a very profitable business, especially with interest rates where they are. But that's kind of my thoughts on Block. I still love some of their core businesses on Square and Cash App. So, I like to keep tabs on how the business is doing, but not really looking at investing in this one. And then on Friday, the only stock I was really looking at is CIBC. I own that stock, so it's one that I try to focus on. And CIBC actually also beat. You can kind of see about a 2% jump here. They had pretty pessimistic analyst expectations, so they beat that. Even at current price, after going up 2-3%, they're still trading at like 9 times earnings, closer to 8 times forward earnings. So for a business that's been around for as long and has consistently performed as long as this company has, I'll take the 6% dividend, paying out 50% of their retained earnings and investing the rest in acquisitions, share buybacks, and other, growth opportunities for the business. I just think it's a good value. So was happy with the report, and this is one that I wouldn't even mind adding more to if I got the opportunity. So that's my thoughts on this week's earnings. I think the most notable takeaway from me was, number one, retail earnings are starting to take a hit and expectations are starting to reset, starting to see some consumer weakness across companies like TJX, Walmart, Home Depot, and their outlook is acknowledging that. And then the second one was just the huge hit that Domino's Pizza took, lowering it to a price to earnings multiple that is a lot closer to what I'd consider. So I'm going to add that one to the watch list and consider, potentially nibbling on a early position if it gets to the right valuation. So that's my thoughts on this week's of earnings. Would love to hear your thoughts on this week. If you have any thoughts on any of the stocks I talked about, or if there's any other stocks on this list or off this list that you are following this week, let me know in the comments, and I'll see you guys in the next one.